Hello everyone, welcome back. Bulls received a nice surprise from the stock market, bouncing right off that 200-day moving average. At the same time, the bond market rallied, causing yields to drop under the 4% level on the 10-year Treasury. The rally in the high yield market, which followed the drop in yields in the Treasury market, one indicator that's giving us a signal that has not executed in several years and only 4 times in the past 10. We have a lot to cover: why semiconductors look like they're getting ready to break out, industrials, how they're setting up for their next move, and why no one cared about ISM PMI. There are several specific names that are breaking out of all-time highs. We're going to cover several of those today. Most important, what is happening with the S&P and what is going to happen next based upon the economic data and also based upon some of the indicators that are absolutely glaring right now. Let's get into it. Hey everybody, welcome back to the #1 channel for stock trading news, information, and education with videos and commentary daily. So what exactly happened on Friday? ISM non-manufacturing PMI came in at 55.1, which is considered a hot number. 54.5 was the estimate. Anything over 50 is expansion, and this was higher than anticipated. I myself even thought put buyers were going to make a killing just simply filling the gap down after the news was released. It was a perfect trade really for them. You have the doji right up here. You can see the flip to the downside, and then we come back and test. It just seems like such an easy gap fill trade for put buyers, and that just was not the case. Made a lot of sense. Now what you did do is you came down and you retested the low. Once you retested that low and undercut and flipped, it became increasingly clear that we had net buyers. You can see how we formed this doji, and then after forming that doji, this particular bar, all of a sudden the top of that bar became your support level, and then we just went on from there, and then from there it was just pattern after pattern after flag all day long. So what happened? Why the higher closing from the first time? We've had a higher high closing in about 5 weeks on the S&P, looking at this weekly chart. What gives? Well, what we're seeing is people are paying attention more to what they are saying they are going to do based upon the economic data, they being the Fed, more than what the economic data actually is. Previous day, Bostic came out, Fed member Bostic came out and said that he's firmly in the quarter point rate rise camp. Now, what's good about this is they're forecasting what they're going to do ahead of time. If they continually move at a 25 basis point rate hike and they're not going to do the 50 basis points based upon what they're saying right now, well, that's very good for the market. The NASDAQ 100, which are the top 100 technology stocks in the NASDAQ, if we just take a look at what's going on, look at how we came to our support level and we held in here very nicely, breaking the 200-day for a moment, flipping back over it, forming a bullish engulfing right there, and then after forming that bullish engulfing, just gapping up. This is exactly what you want to see. This is what we would refer to as a retest of a key area. What's nice about this retest is that not only did we hold the 200, but the 55, which is in purple right here, moving average, we held as well. So we've come down, we've retested this area, and we've held all the key long-term metrics of the market. You can see the high yield market, HYG right here, getting back and closing above its 55 SMA for the first time. 55 is in purple, and you held the 200. This is really important for us to watch and to make sure that people are buying high yield bonds. Now, the long end of the market, TLTs, a 20-year Treasury, is still struggling to get above the 200-day and the 55, but the appetite for high yield bonds is still out there. This does not happen when you're going into a recession. People sell these bonds. They do not buy them because they're worried about the debt load and if they have the ability to pay them. So what we're seeing here is we're seeing somewhat of a splinter. Now, in front of us is consumer discretionary or retail divided by the staples. In other words, are staples outperforming or are consumer discretionary retail outperforming? Well, in a strong economy, you will see retail outperform. In a weak economy, you will see staples outperform. This is pretty standard to look at. But I just want to show you this key level that I'm noticing. You can see every time we've been getting down here since May 22nd, back in the day, right, as we're now going to refer to it, that became resistance, this area, and this relative correlation is now finding support there. It is below the 200-day, but we are not taking out lows anymore on this, and that's the important part. While everyone is waiting for the market to continue to come in, Since December, people have been buying beaten down retail names, and they are selling the Procter & Gamble's in the world on a relative basis to that, which is causing outperformance of retail. Once again, you don't get outperformance of retail in recessionary times. In front of us is the McClellan oscillator, and the best way to think about this is as a medium-term indicator. And really all we're looking to do is we're looking for anomalies. Anything under 50, this negative 50, is considered extreme pessimism. Anything over is considered extreme exuberance. And you can see this very clearly where we were exuberant at the end of January and how fast we flipped. This is a pretty fast flip, but we just take this point and come across and just look right in here. How many times were we actually below or on this line in the past 2 years? And what you'll notice is it's only a couple times you've actually even been able to get below that level. Now, if you look at those readings when you're below 2 to 3 weeks later, it usually provides a decent opportunity. What I really like about this is there is a zero line right in here. And if you use the zero line and you watch the flips that have follow through from that zero line, which we are now approaching, you start to see the momentum shift from we're not negative to, okay, we're neutral to now we're getting positive. And that's when you're starting to see those moves from that period in time. And that actually leads to some of the largest moves that the S&P has had. So there is value in this oscillator, and I would suggest that you continue to look at it. The importance of oscillators and indicators is to understand how they're calculated, and by doing that, you can utilize them better. Now, no graph illustrates this better than this right here. This is the 10-year Treasury. Why does this illustrate it the best? The people that gapped up ahead of this number, they were so convinced that this number was going to be so bad that they gapped up to sell their 10-year Treasury during normal trading hours. That's why you have the gap. Now, on a 10-year Treasury chart, you have what they've referred to as an island reversal or abandoned baby pattern. What's fascinating about this is the gap down from the open. So it's very clear from this gap down that they were expecting that they needed to buy treasuries from the morning. And you can see that you even have that little uptick right there where you tried to fill the gap at probably around that 10 o'clock level, and then you just pulled back, and then you had bond buying all day long. So why are they buying bonds in the environment where we're seeing ISM and PMI come in higher? Well, what I'd like to remind people is, are you trading the stock market or are you trading the economy? Because it's two different things. The stock market's a discounting mechanism. Now, if you look at what the Treasury market just did here, it's telling you pretty much everything that you need to know about the move. You don't have gap downs in Treasury yield very often. A matter of fact, if you were to look at this chart, how many times have you seen that? We have one here. We have one here. It's very, very rare that you see these, and it usually means that you have a change in trend. And what that change in trend usually means is that you have a couple weeks at a minimum of buying Treasury. So why are they doing it? They're doing it because the Fed is telegraphing their move. The Fed is telling them that they are only going to raise 25 basis points. Now, there could be several reasons why they're going to do this. And I'm not going to get into them all, but until that changes or until this data comes out so poorly that the dollar spikes and gets back over the 200-day moving average, until we see something like that, we have to go on the premise that they're going to stick with the status quo. Now, should they see something they don't like, it could absolutely play with us and they could absolutely raise 50 basis points, and then this could change. Understand that when we're going over trading and we're going over charts and technical analysis and moves, this is dynamic. This is not static. In other words, it's ever changing. It's one of the reasons why I like doing daily videos, so that we can talk about what's going on, stay informed and educated, and then try to make better decisions based upon the most current information. Now, last week I showed this graph, smart money, dumb money, confident. And essentially what this is showing is inflows of capital. Now, the way that we are going to use this is we're going to get rid of the words smart money and dumb money. As we said before, we're going to call this institution that's in blue, or funds, think pension funds, mutual funds. Dumb money, think your retail trader. The reason I want to change those is because Dumb money refers to the fact that if dumb money is coming in, that they're making the wrong decision. That is not how you should be utilizing this. And this is one of the reasons why I stress when you understand how these indicators are calculated and what they represent, you can actually utilize the data maybe in a more efficient way than even the people that created the indicators want you to do. So now that we understand what these two are, we can understand really clearly here. Now, in October, did you want to be, quote, smart money, or did you want to be dumb money? I would have preferred to be dumb money and to be buying from October all the way into January, right, mid-February, and then selling to, quote, smart money. That seems like the smart move to do, right? Because I'm interested in a return, not interested in the label that you're going to give me. Now, to be clear, over the course of the past 6 months, just the last 6 months alone, we have seen, quote, smart money funds get crushed on a performance basis by, quote, dumb money or retail. Look what's happening here once again. You see the cross right in here in January where retail says, hey, we're going to push, we're going to get involved. And institutions are reading the data, looking at the numbers, hiring economists. What are they doing? Getting to the lowest level possible that they could have. How's that working out for them? It's not working out too good, right? Okay, so you're at your lowest level here. And then as the market's dropping, they're buying into the market. And guess who's selling into that drop? The people that made all their money back here. So what do we see happening again here? Why are we zooming in on this? Why are we focused on it? We're focused on it because you're seeing this level bounce again. And we're seeing retail act on the numbers that came out with institutions selling into those numbers. And people are going to look at this graph and say, well, smart money selling, therefore I should be out. I'll stick with retail right now. They seem to have a better read on what the data is actually suggesting and what's actually going on than institutions do. The beauty of this move and why it's so significant is because eventually institutions are not going to have a choice. Now, when that choice happens, we really don't know. There's no better illustration of this than the pandemic. So here we are at trough levels, and then here we are right here, right? So who rode this whole move down? Quote, smart money. So we're going to zoom in here and really focus on this level for a moment. When did retail start buying during the pandemic? Towards the end of the move. When did institutions start buying? Oh, they were buying the whole way down, peaking out, and then as it rallied, they were selling. So how could their performance have been better than retail? It's just not even feasible if you look at this graph and know how to read it properly. You can see how the entire time they're selling. Meanwhile, look at what retail's doing. Also, look how long it takes institutions to make decisions versus retail. Retail's nimble. I think this is one of the most misunderstood charts out there. What you want to do is you want to look at the performance of retail versus institutions, not just assume that one is smart and one is dumb. What's interesting about that is there's an indicator about to go over in a couple minutes here. It's only given a signal 4 times. And you could actually say that it's tied to retail in an extent, but tied to retail in the know. We're going to go over it in a moment. But you see the trend line right here? See the flip of that trend line on the S&P? See where we were unable to break it? This is really significant stuff. So we're holding this level, and this is what's called backfilling. And then what we've done is we've held in here. Again, this is what's going on right now. The market is extremely dynamic and things change. They can change at any time, right? We're all seeing that level right there. We're all seeing this in what I refer to as a kill zone and how we got into that and then we reversed by the end of the day. Now, that's all on Friday's move, that high, right? Even though we're looking at a weekly chart. So we can see that we're flipping there, but we should really go over just the absolute glaring pattern that's staring right in front of us. And you should be able to see this, but left shoulder, right shoulder. Necklines do not need to be straight. But if you want to do this and say, okay, well, that's not the neckline. My necklines, they're always straight. It's not a problem. You would just very simply come here and draw this. I'm drawing them thick on purpose. And you would look at this level and see how that is, right? So that would make a little bit more sense to some people. I don't mind the angled neckline, but the bottom line is that we are not making lower lows. And until you start making lower lows on the index itself, it's very difficult to continually sit there and be bearish and talk about how we haven't seen the lows yet. We're heading into October, November, December, January, February. Okay, I don't care if the market comes back down here and it's September. I'm interested in what it's going to do next week and then how we're going to take advantage of that. Before we start getting into some of the names, I think we should just look at the NDX and see very clearly that you have a W here. W patterns, when they form, you usually do not see them form and then all of a sudden break. Now, obviously that can happen, but that's not what's happening here at all, is it? But we could see this rally up. You could see this just come back down and then rally up. But until you start making these lower lows, it's very difficult to sit there and be bearish on the market. I could see how high yield could give us some pause. Here's the 200-week moving average. You can see the slope, but we are still pointing up. But again, you see this left shoulder, right shoulder, head pattern. And if this is your neckline, you still don't have a decision. Now, the beauty of what's going on here is they're making our lives very, very easy. And I'll explain what I mean by that. If we're here and we start taking out these lower lows, well, that's definitely something that I'm going to want to pay attention to. And by making them higher, they're allowing us the opportunity to utilize these levels as potential sites that we may have a problem. You want to watch high yield, and the fact that high yield is rising and that the bond market and treasury yield is not rising as much is significant, because that means credit spreads are getting tighter. As credit spreads get tighter, more people are going to buy high yield. Why is that? Because it means that the health of the overall company is better. Very quick side note, CRM. $20 billion stock buyback. If they were worried about the future and they were worried about what they're seeing going out there in a recession, they would not be buying $20 billion of their own stock. They would be stockpiling. Meta, $40 billion stock buyback. If they thought that their stock was going to go significantly lower, they would not be doing that. If they thought that they were going to hit recessionary times and have issues, they would not be committing the way that they are committing. I'm not suggesting that you look at either of these charts from a trading standpoint, but what I'm suggesting is you look at the overall health of the current companies and what they're saying during their earnings reports. In front of us is the S&P on a monthly basis, and you can see these levels marked off. I'm going to explain what those levels are right now. This is a chart of corporate insider sells, meaning are they selling their stock right now? It has nothing to do with whether or not they are buying. Are they selling? Excessive optimism is here, meaning that they're optimistic to sell. Excessive pessimism is here, meaning they are not excited to sell. And I just want to point something out here going over a very simple 10-year period. Okay, you are at a level that is the lowest in 10 years with how excited they are to sell their stock. During this time, getting under this level is significant. And you can see that this happened during the Great Financial Crisis, 2016, 2018, and our recent correction, which has got you to the lowest level of pessimism, unwillingness for corporate insiders to sell in the past 10 years. Anything above this means that they are optimistic to sell. So we have 1, 2, 3, 4 data points. Now, if we look at those 4 data points, and of course I would like more, but that's all we have are 4 data points. So if we look at from that period on, at the beginning date, and we just come across and we want to understand what that would mean on where we would finish on that period of time, we can see that in this example, from when we turned over the course of about a year, that we're getting about a 22% return. If we take the 2016 example, we're getting about a 22% return. In 2019, we received a 29% return. And of course, people could have been in here and got hit by the pandemic. There's very little that we can do about something along those lines as a geopolitical event or some extraneous circumstance that we're not aware of. This is where we're at right now. If we take this bar and we just extrapolate out the 22% from there over the course of the next, call it the next year, okay, that puts you back to a retest of the highs. I want to be real clear about this before we go forward. This is a long-term indicator. This is not saying that we're going to move on a Tuesday or a Wednesday. It is a long-term indicator, and I would not sleep on it. Statistically speaking, I need way more data points. You would like 30 data points for something to be statistically significant. You're not going to get that here. So we have to take what we have and then try to extrapolate from that and see if we can get enough information. I think that is enough information that when insiders don't want to sell their stocks, and when corporations see the value in their company so great that they are literally committing billions of dollars to buying their own stock back, they could just as easily be buying treasuries. yields. Remember, the 6-month treasury is now paying 5.14%. They could easily park their capital there and then even use that as some kind of income, expense, or earnings, something along the lines that they could show how that is profitable and how their investments are profitable and help with their bottom line. It's not what they're doing. They're buying their stock back. When we have this much uncertainty and we have this many people that are still fighting the fact of what is going on, it creates enormous opportunity. We're seeing names like NVIDIA. This is a dragonfly doji. You can see it right here at the top of the chart. A lot of people don't like them at the top. They'd rather have them at the bottom. In my experience, if I have a reversal bar at the top of the chart, it usually means that we're going to push significantly. Right up here, this is pretty substantial to me. And I'm looking to see if NVIDIA can get up to that 267 level. Once it prices, it's got a outstanding issue where it is pricing some convertibles and some bonds. Once that's done and that pricing's done, you'll see people, they're either going to get what they thought they were going to get on that pricing or not, and then they're going to want more exposure. That pricing could happen over the weekend. It could happen at any time. Once that happens, I do think that we're going to see some kind of push and retest of this breakdown bar. There's very little in here to stop versus what we just got through. So I would not sleep on NVIDIA here. We can say everything we want about Tesla. It's overvalued. It's this, it's that, right? I know a lot of people don't like the name and don't like him, but I really rather just look at the chart. And if you just kind of take a look up here, and even if we just drill this down just a little bit, right? So what I'd like to do is I at least try to get at least 1 or 2 openings and closes at a level, because that shows where people actually, the decision makers are, right? Who sells at the close? That's usually institutions. Buyers are usually retail. So it kind of gives you an understanding of where you're at. And you can see how you came right in here and you hit that 218 and just bonked right off of it. But you're forming a flag on Tesla. And you're back above what? Your 200-week moving average. So I don't know that this is the best idea right now. I thought their investor day was an absolute disaster. It was more like an infomercial. But what I'd like to see is I'd like to see if this can break out to that 218 level now. Most people are not going to want to wait for that or trade off a weekly chart. There's very little redeeming here in stating that you need to get in right away. Now, if the market lifts, then the market lifts, and then this may act as a proxy. But with over 55% of all stocks in the S&P above their 200-day moving average, buying a stock that's sloping down is probably not optimal. So I do want to see for a long-term trade, it get above that 200-day moving average and flip. You can see all these dojis in here. You can see all that uncertainty. We still have a handle that's sitting right here, and we can see the cup that is sitting right here as well. I'm also not crazy about how volume has been sloping and declining. Coin is a name that I've been very bearish on, thinking that it might be my next, quote, zero. And I don't see it that way anymore. Now I'll explain why I'm starting to warm up to the idea. Number one, technically, you're holding your 200-day moving average. Number two, with the news that's coming out about SI and Binance, this stock should be getting absolutely crushed in relation to its exposure. Matter of fact, we're seeing the exact opposite. We're seeing buyers actually step in, and we can kind of see this little curve that I'm drawing here where you're trying to break down and then you're just kind of still rolling a little bit higher. This is on my radar now as a possible long idea. I don't think I'm there just yet, but it's definitely something that if you look at, you can see how substantive it is. If Binance goes away, or Binance has some of the similar problems that the Forbes article is stating, let's say that they do have some similar problems to FTX. Who's left? Who's the one that's going to be regulated? And you have to remember that what you dealt with on the crypto side is exactly what we dealt with during the dot-com boom, where thousands of cryptos are going to go to zero, just like thousands of dot-coms went to zero. But you're going to have 2 Amazons, right? You're going to have 2 Amazon kind of companies come out of that. Something to think about. Is Coin going to be one of those? I don't know. I would just have this on my radar. I don't know who's going to be the last man standing, but it's going to be 1 or 2 brokerages. Now, before we get into the next name, you need to understand what's going on at the SOX. These green arrows denote an inverse head and shoulders. Left shoulder, head, right shoulder. Every breakdown is a lower low, and we are right back to what? The neckline. We tried to flip the neckline before, and we were unable to. But there is a very big distinction that is changing right now, and we need to pay attention to it. Do you see my 200-day moving average? Watch the numbers up here to the left. See how they are down, and now they're starting to go higher? See how they're moving higher? See how they have not been moving higher the entire time? Now, all of a sudden, they are starting to point higher. What does that mean? Well, this is a really quick tip and a really quick secret, I guess, or trick for you guys to use yourselves, guys in the general sense, is that we're getting a sloping of a line. So if you're looking at a line and don't know if it's sloping or not, just go read the numbers. If the numbers are going higher, it's sloping, right? It's sloping higher. If the numbers are going lower, then it's sloping lower. AVGO didn't exactly crush. They beat by a little bit on the earnings and revenue front, but guidance was substantive. And you can see the gap up and the just sheer amount of volume that was created on that day. And I like this a lot. I really do. I was waiting for some kind of pullback, frankly, on Friday, and we're just not getting it at all. But when you have setups like this, where you have these wedges down, you're breaking out of those wedges, you're breaking these higher highs over and over again, and you're setting up to break the next one. It's just a matter of time before this starts getting back into this upper channel. And the upper channels here, they're pretty substantive. So this is not one I'm going to just draw both in. You can kind of see the range on where they're at. This has a lot of potential, and it's definitely something that's on my radar. The fact that we've just been basing for close to 2 years. IBKR is one that is in the newsletter for the Alpha Chasers community. If you want to follow along, a daily newsletter goes out, link in description. Start looking for stocks that are hitting all-time highs. And you're going to say, well, there's not many. Well, that's not accurate. There are a lot that are setting up to break. And this is one of them that's just forming this high, tight flag. And look at where you closed. You closed at the all-time high. So this is setting up to break. Really fun fact. 70% of stocks that get to 90 for the first time usually hit 100. This is another one that we should really be paying attention to. We have a position of about $15 in it. And what I like about this is it's hitting all-time highs, and it's 17% of the XLB, which is the basic materials sector. Basic materials is considered an offensive play. In other words, it's not healthcare, it is not XLP, it is an offensive play. And when you're starting to see this, this means that they are putting money into work. You're setting up here perfectly. Lin is 17% of this. Here's the industrials. You can see how they're setting up. Industrial stocks do not push towards new all-time highs, which is exactly what this is doing during a recession. It does not work that way. This is a huge year flag that is building here and setting up to push. Top names are right here: John Deere, Caterpillar, and Boeing. XOP was one that looked to me like we were going to crack, and this is really important. So here I have a Head and Shoulders, and this one's pretty wonky, right? Because even the shoulders up a little bit above the neckline. So a lot of people are going to get super technical with me and say it's not a Head and Shoulders. To me it is. And it broke my neckline right here, but look at the reversal, right? So in other words, when you have a pattern and that pattern does not break, this one did not break, look what happened. Very cursory glance using Market Watch, you can just see all the top holdings there, and you can go and take a look at those names for yourself. AI was one that they were trading in the community the other day. I actually took a position, didn't hang out too long, but it looks phenomenal on a weekly basis. Take a look at that chart right there. That looks absolutely phenomenal. You've been basing for over a year now. This is exactly what you want to see. You come back, you test. Now you're through earnings, and it's in one of the hottest spots out there right now, AI. Do not sleep on this and that 29.5 level. Thank you for watching, and thank you for your comments about the longer form videos. I like doing the longer form. As long as it's accepted and people are enjoying them, we'll continue to do the longer form content. I think there's a lot of value that is in me doing a long form content. If you like this, do me a favor and please share this video on your social media. Please get it out there. Subscribe if you're not subscribed to it. It's really important to me why I'm creating this content, so everybody gets this. You'll notice I don't run ads. You're never going to see anything from me promoting something in these videos, which I get asked to do all the time. The purpose of me creating the content is relatively simple. I just want to inform and educate people so that they can learn what it takes to truly be successful doing this. And by you sharing that message, it gets it out to more people. I was very fortunate when I started my career to be around a lot of people that were very savvy with the market, and that helped me greatly. So I'm trying to pay that forward and get the message out there, and that's why I'm doing what I'm doing. Any questions, just reach out as always, and comment below on what name I missed and what name you're going to watch next week. Sometimes you guys come up with some really good ideas, so I appreciate them and keep them coming. Have a great day, everybody. Trade to win next.